Welcome to this explainer. Today, we are unpacking a really massive financial mystery that's been playing out right in front of us. So, as of May 9, 2026, if you've been watching the markets at all, you've probably noticed a glaring contradiction. The traditional stock market is absolutely roaring to record highs, but the cryptocurrency market, it seems strangely trapped. You kind of have to wonder, why is it that digital assets, with all their growing real-world utility, are suddenly struggling to catch that same tailwind? Well, today, we're going to look right past all that daily price noise and uncover the massive, unseen plumbing that Wall Street is quietly building just beneath the surface.
Okay, let's dive right into this and outline our journey for today. First, we'll look at the great market decoupling. Second, crypto's new financial plumbing. Third, Ethereum's explosive tinderbox scenario. Fourth, altcoin moon targets unveiled. And finally, we'll wrap up with the new institutional floor. Section 1, the great market decoupling. To really understand where we're going with this, we first have to recognize just how completely strange this current market environment actually is. We're witnessing a historic divergence between two asset classes that honestly used to move almost in perfect lockstep. Think about it using an iceberg model. Up on the visible surface, in the sun, the S&P 500 is in the middle of this historic $6 trillion melt-up. It's entirely driven by the AI boom, hitting record high after record high, and the broader market is in a state of absolute greed. But look underwater at digital assets. Bitcoin and the broader market are stuck in a serious structural bottleneck. Retail investors are completely sidelined by extreme fear, leaving the market trapped in this frustrating range-bound state, dealing with its own distinct supply and demand frictions. Analysts have actually pointed out a missing ingredient in the current crypto cycle, and it's likely a lack of cheap money liquidity from the Federal Reserve. Look, during the last bull run, Bitcoin was basically just a risk-on proxy for tech stocks. It was floating on an absolute sea of low interest rates. But right now, without that cheap liquidity to match the AI-driven stock rally, Bitcoin has hit a macro ceiling. It's no longer just blindly following tech, it's actually being forced to act as a distinct asset class. Section 2, crypto's new financial plumbing. Now, what's really interesting about this is that while retail traders are paralyzed by fear, institutions are actually laying down permanent, highly sophisticated infrastructure. Coming out of the recent Digital Asset Summit in New York, a massive theme emerged. 24/7 equity perpetuals are beginning to absolutely overtake traditional options for institutional price exposure. These perpetual derivatives give professional traders exactly what they want: continuous, around-the-clock exposure in a market that literally never sleeps. And get this, they aren't just doing this for crypto. Wall Street is using these tools to target traditional hard assets, like silver and crude oil. They're actively co-opting crypto's native plumbing. $595 million. That is the cumulative volume for weather markets on the prediction platform Kalshi. When most people hear the term prediction markets, you probably think of sports betting or degenerate election gambling. But the reality is far more serious. These prediction platforms have quietly evolved into heavy-duty financial infrastructure. It is frankly fascinating to look at who is actually driving that $500 million in volume. It's definitely not retail speculators. It's energy companies, it's agricultural traders, it's massive insurers. They're using these markets for highly capital-efficient climate risk hedging. And by leveraging this setup, Kalshi is generating roughly $15 million in annual fee revenue just from these weather hedges. So what's the big takeaway here? It proves that this complex risk management infrastructure pioneered in the crypto space is becoming a permanent fixture in global finance. Section 3, Ethereum's explosive tinderbox scenario. Okay, so now that we understand the broad structural plumbing, let's pivot and look at specific asset mechanics. And we really have to ask, why on earth has Ethereum emerged as one of the most heavily shorted assets globally? Even with a few signs of life in its price action, there is deep institutional uncertainty regarding ETH's near-term recovery, and professional traders are betting heavily against it. And this brilliantly illustrates what we call the tinderbox setup. You have these massive global short positions stacked up right against a critical price resistance level of $2,400. Think of all those short positions as highly flammable fuel. If Ethereum's price can gather just enough momentum to decisively break through that $2,400 ceiling, boom, it forces all those short sellers to immediately buy back in to cover their positions. That creates a massive short covering rally that forces prices exponentially higher, completely regardless of what the broader macro backdrop is doing. Section 4, altcoin moon targets unveiled. While Ethereum is setting up for that potential short squeeze, market pundits are closely watching the broader altcoin space.
Specifically, they're looking at new protocol integrations as the major catalysts for the next leg up. Successful cross-chain execution is leading to some pretty wild, speculative moon targets. We're talking about discussions of Solana potentially hitting $500 and XRP being targeted for $10. These targets are being driven purely by optimism around actual functional integrations between these networks.
But let's ground those sky-high targets in reality for a second. The market right now is an absolute trader's battleground. Volatility is sitting at multi-year lows. That retail FOMO, the fear of missing out that supercharged previous cycles, is practically non-existent. Right now, traders are just desperately searching for clear directional signals in a market that's moving sideways.
Section 5. The new institutional floor.
Let's move to the timeline and see how this all builds together. In the past, crypto was purely a risk-on proxy for tech stocks. Today, in the present, it is a distinct asset class dealing with its own supply-demand frictions. But looking ahead to the future, we are seeing the rise of institutional weather hedging and 24/7 equity perpetuals. This utility and complex risk management provides a genuinely powerful long-term floor for the entire market.
So what is the exact number we need to watch? $78,000. That is the true market mean for Bitcoin. Analysts believe that reclaiming and decisively holding that specific metric will be the concrete signal that this frustrating market decoupling has finally come to an end.
So the crucial point is this. Right now, institutional hedging volume is the only thing compensating for the complete lack of retail FOMO. Institutions are quietly and methodically locking up the most valuable pieces of this new financial plumbing. The big question we have to leave you with is, will everyday retail investors shake off their extreme fear and return to the market before Wall Street permanently takes over the infrastructure? It's something you definitely want to keep an eye on. Thanks so much for joining me for this explainer.